Brace yourselves because Dr. Doom is back. Despite my history of bringing up movies, I promise I'm not talking about Victor Von Doom of the Fantastic Four. I am referring to Nouriel Roubini, the economist who foresaw and predicted the subprime mortgage crisis, thereby earning the foreboding, dark title of Dr. Doom. That has to be pretty cool on a business card, right? Dr. Doom, Roubini, once sat on the Council of Economic Advisors during the Clinton administration. He has degrees from everywhere, and as the son of Iranian Jewish parents, brings a unique perspective to economics. Roubini's work, it's collectively ominous and unabashedly negative on the future. He is the author of Crisis Economics, a crash course in the future of finance, and Megathreats, 10 dangerous trends that imperil our future and how to survive them. The latter book addresses the mother of all debt crises as total debt goes over 350% of global GDP, as well as demographic time bombs addressing aging workforces and strained pensions. He discussed a long stretch of stagflation as a big risk, as well as the AI and automation-driven job disruption. You need to be armed with a glass of wine in hand and a flippant Friday night attitude if you're going to sit down on a recliner for an evening Roubini read. Dr. Doom has more than fairly earned his appellation, as he is, more often than not, correct with his prognostications, unlike Columbia, South Carolina native economist Harry Dent, who makes a living predicting doom and gloom. Dent wrote such ill-timed books like The Great Crash Ahead in 2011. And that wasn't the only one. If you listened to Harry in 2011, you would have missed out on the greatest bull run of all time. Why bring up such a negative Nancy and Nouriel Roubini? Well, Dr. Doom is going to have to file for a name change to Dr. Delightful if he keeps talking like he did during a recent appearance on Bloomberg Television. According to him, the U.S. is in a productivity revolution. Come again? I reread my screen, and his quote was plastered on there. It said, "The U.S. remains at the center of a technology-driven positive supply shock that raises growth and lowers inflation." The host said he was bullish through 2030, and he agreed. Say what? That sounds downright positive. Roubini goes on during his Bloomberg sit-down to talk about the Atlanta Fed's massive GDP forecast of 5.4% and productivity numbers as high as 5% when they were at 1% through 2019. He said he was a bit skeptical of the number, but it's definitely accelerating, according to him. He admits that wage growth and job numbers are languishing, but argues that strong GDP numbers and a weak labor growth equals a productivity revolution. He points out that the 15% growth since 2022 of the S&P 500, of 5% per year, and 20% growth of productivity numbers since 2022 of technology is that productivity revolution. He also says that the weak wage growth equals more profitability for corporations. The host asks him about the increasing risk of militarization, and he downplays it, citing the lack of a drop in markets during the 12-day Israel-Iran war of 2025 and very little effect from America's Venezuela incursion. This positivity shock from Roubini comes off as anachronistic, as it blasts across a very tense economic background. Valuations are undeniably high collectively, and company values in many cases are stretched. The S&P 500 Shiller-Cape ratio is a great way to assess the overall valuation level of U.S. large-cap stocks. So let's take a look at the chart. The market is at its second highest all-time level if you group the readings by a relative time period. January of 2000 marks the highest reading at 43.77. The days and months surrounding that were at a higher level than now, and we know what happened after. But other than this one spike in 2000, we're presently living in the highest valuation in S&P 500 history. Now that's a mouthful. Our friend, Dr. Doom, would not be viewed as a crazy outlier right now in this highly valuated stock market if he had trotted out to the TV set and said, "A crash is imminent," or "Sell now, not later." The Bloomberg host would have probably said it was very timely, but he didn't do that. He was remarkably positive and optimistic going forward. So what do we do with this prediction? I think it's possible these ideas aren't mutually exclusive. We can have a world with high market valuation and the resulting trepidation and feelings of leeriness of an impending drop, while also still believing in a growth thesis. What goes up can go higher. In fact, that's true 70% of the time if you look at the last 100 years of the market. There have been lots of recent highs in just the last 15 years. Look at this graph of S&P 500 performance since 2010. Please follow the orange line of the S&P 500 since 2010 and count for me all the all-time highs you see. Go ahead, I'll wait. Granted, I'm showing you a historic bull run that was interrupted on several occasions with short bear markets, but you get the idea. The history of the stock market is made up of all-time highs, and all but a handful of them are lower than the market today. The market, historically, marches onward. That being said, as fiduciaries, we maintain a cautious outlook due to the overall valuation of the market and the concentration of much of the growth in technology. To say that market performance as of late is tech-driven would be to make the understatement of the new year. Generally, right now, it's going to be prudent in many cases to take some risk off the table with about 10% of your assets. Your advisor will dive into whether that's right for you and your situation. But Roubini is sounding an unexpected trumpet, and for once it's not one of the 7 frightening doomsday trumpets of divine judgments on the earth from the book of Revelation. Roubini's no longer preaching doom. He's preaching growth. We believe it is possible to represent both ideas in managing your portfolios and your risk, subject as always to your time horizon, financial goals, and risk tolerance. Things are happening in the world so fast, it's really hard to track. We can tell you that as an investment committee, we're really happy with the extended ETF portfolio we examined in detail yesterday. You can think of it as thematic investing, if you will, but we're tracking the news trends and lining up ETFs we think will match those. Last year, we got into an aerospace and defense ETF, for instance, and added technology exposure. Both moves look to be correct in hindsight, and we're looking forward to showing you the results at our State of the Markets class at Topgolf on February the 5th. If you have not signed up, please give us a call. We think this trend of technology and defense will continue as we see Trump looking to tamper by offering money to Greenlanders and putting Greenland in the transfer portal. He did so in a White House tweet that the U.S. will put more money in your pocket, just a reminder, with a picture of Trump hefting a sack of money over his head with a tagline, "No tax on tips." It turns out the White House has a writer as cheeky as I am. We also note from open source intel at least one carrier strike group on its way to Iran. Xi Jinping's not getting any younger in China, and he turned 73 this year, so if he were a U.S. citizen with an IRA, he'd have to take his first RMD soon. He still has Taiwan on his mind. As portfolio managers, we're looking to help you take advantage of the prevailing trends in the world and turn those into more dollars into your portfolio. As advisors, we're looking to make sure that you're properly allocated according to the risk that you want to take in the market. For some of you, what I've said here about valuation will trump Dr. Doom's very pleasant forecasts. For others of you, Dr. Doom's words will be encouragement to lean into your investing. Call us and let us know if you're on Team Doom or Team Delight. And waffling in the middle is fine too. Remember, if you listen to us, we'll change your financial world. And now a word from our compliance department. Past performance is never a guarantee of future results. We offer a lot of services. Our planning, tax, and insurance strategies are designed to improve financial outcomes when implemented as recommended. We're confident in these strategies, but results will vary based on individual circumstances. Investment results cannot be guaranteed. Unless otherwise indicated, no third-party individuals mentioned in this video are clients of our firm, nor have they been compensated for appearing. This video is for educational purposes only. For personal advice about your situation, please call our office.